PayPal just reported their Q2 2026 earnings, and they actually beat consensus on both the top and bottom lines.
Yeah, they really did.
We are looking at net revenues hitting $8.68 billion and non-GAAP EPS coming in at 1.38.
Right, which was a solid beat. And they even raised their forward guidance, too.
Exactly. They raised their full-year transaction margin dollars guidance to roughly $15.6 billion and pushed the low end of their non-GAAP EPS up to 5.38. And the market definitely liked what it saw. The stock is up in after-hours trading.
It rallied pretty much immediately after the print dropped.
Yeah. So let's just get right into it. Welcome to today's deep dive. We're looking at a massive stack of official financial presentations and the earnings report for PayPal's Q2 2026.
There is a lot to unpack in this one.
There really is. And the mission for this deep dive is to figure out what is actually going on under the hood over there. Because under Enrique Lores, the president and CEO, this company is going through a massive transformation.
Oh, absolutely.
We need to figure out, are they still a hyper-growth tech darling, or are they transitioning into a mature financial institution? Or, maybe something else entirely?
That is the big question right now, because their raw processing volume is just staggering, but the profitability profile is shifting so fast.
Right, so let's start with what I call the top-line tug-of-war. Before we even get into any flashy new products, we have to look at the scoreboard.
Yep, the fundamental metrics.
Exactly. So total payment volume, or TPV, is up a massive 10% year over year. That hits $486.4 billion for the quarter.
That is just a huge number.
It is. For you listening, just let that sink in. They processed almost $500 billion in just 90 days. And tracing right along with that, net revenues increased 5% to that $8.68 billion we mentioned.
Which sounds fantastic, right? Like 10% volume growth at that scale is exceptional. But Wall Street isn't just looking at the top line anymore.
No, they are looking at the bottom line.
Exactly. They're scrutinizing the operating income.
And this is where the tug-of-war comes in. Because despite handling all that extra money, their non-GAAP operating income actually dropped 8%.
Down to $1.5 billion.
Right. And operating margins contracted by 248 basis points, landing at 17.4%.
Okay, I know basis points is like super standard finance speak, but let's break that down. What does that actually mean for their wallet?
Well, it's just a highly precise way of saying their profit margin dropped by almost exactly 2.5%.
Okay, got it.
So think of it this way. For every $100 of revenue PayPal generates from moving money around, they are keeping $2.50 less in pure profit than they did last year.
Wow.
And when you apply that drop across billions in revenue, you get a massive hit to their operating income.
Okay, let's unpack this. They are processing more money than ever, but keeping less of it. It's like a widely popular restaurant that has a line out the door, right?
Right.
But they are somehow making less money per meal because they decided to renovate the kitchen during dinner service. Why the huge disconnect with the shrinking margins? What's fascinating here is that this margin compression, it isn't an accident.
Really?
Yeah, it's not a mistake. And it's not just competitors undercutting them. This is a deliberate choice by the management team. To see why, you have to look at their non-transaction related expenses.
So they're OPEX, basically.
Exactly. Operating expenses. That number is up 9% year over year to almost $2.4 billion.
Wait, $2.4 billion on operating expenses in a single quarter. What are they even buying with that? Are they just hiring a ton of engineers?
It's a mix, but it is heavily weighted toward infrastructure and platform stability. Management literally said in the release they are moving with urgency to sharpen their transformation plan.
Okay, so they're rebuilding.
Yeah, you have to remember PayPal is built on decades-old legacy tech. To transform that kind of global plumbing, you have to pay down technical debt. They are intentionally taking a hit on short-term profits to fund a massive internal rebuild.
Okay, that makes sense. But there's another layer to this margin squeeze too, isn't there? It's not just the OPEX, it's the actual products driving that $500 billion.
That is a crucial point, yeah. The profit margin depends entirely on how the transaction happens. And right now, PayPal is basically a three-headed monster.
Right. So we have branded checkout, Venmo, and Braintree. Let's break those down because they behave very differently. First is the legacy branded checkout.
The classic yellow button.
Exactly, the button you see when you buy shoes online. The report says this segment stabilized at 2% growth. So it's not setting the world on fire, but it stopped bleeding market share.
Right, and stabilizing that was priority number one for Enrique Lores. It's historically their highest margin product. But, 2% growth doesn't drive a 10% overall surge.
No, definitely not.
The real growth engines are Venmo and Braintree.
And the numbers there are wild. Venmo debit card monthly active accounts grew by over 50%, and pay with Venmo accounts grew roughly 30%.
Which is massive adoption.
It really is. And then Braintree's total payment volume saw mid-teens growth. For those tracking, Braintree is their unbranded enterprise processing arm.
Let's pause on Braintree because that's the key to the whole margin squeeze.
Okay, go for it.
When you pay for a ride on Uber, you don't usually see a PayPal button, right? You just enter your credit card.
Yeah, it just feels seamlessly integrated into the app.
Exactly. But behind the scenes, Braintree is the invisible plumbing processing that card. That is unbranded enterprise processing.
Okay, so volume is surging through Venmo and Braintree.
Yeah.
But here's where I get stuck. When I look at the overall user base, it essentially flatlined at 439 million active accounts.
Actually dropping slightly, yeah.
Right, it dropped by like 200,000 sequentially. So how on earth is payment volume up 10% if they are actively losing total users?
I see why that looks contradictory, but you have to look past the total user count and look at a metric called TPA.
Payment transactions per active account.
Exactly. Over a trailing 12-month period, TPA grew 3% to 60, and if you strip out Braintree, core TPA actually grew 7%.
Here's where it gets really interesting. If active accounts are slightly down, they aren't widening the net at all. It's like a band that stopped trying to get new fans and is just selling way more expensive merch to their diehards, right?
Yeah.
They are just squeezing their existing 439 million users harder.
If we connect this to the bigger picture, yes. That is exactly the structural pivot they're making.
Okay.
For a decade, Wall Street just wanted user acquisition from fintechs. Grow accounts at all costs.
Right, the classic tech startup playbook. Give people $10 to download the app.
But an empty account doesn't make any money. Actually, it costs PayPal money to maintain it, server space, compliance, all of that.
It's just liability.
Exactly. So they aren't throwing money at empty new accounts anymore. They're entirely focused on deepening engagement.
So taking a Venmo user who just splits a bar tab once a month and getting them to use the debit card for their daily coffee.
Precisely. It's a pivot to higher value interactions. They don't need new users if the existing 439 million start transacting 60 times a year instead of 50.
That makes perfect sense for volume. But back to our margin problem. Braintree and Venmo must have a totally different margin profile than that classic yellow button.
Oh, totally different. Think of Braintree as a wholesale business, like a supplier selling flour by the ton to massive commercial bakeries.
Okay.
You deal in massive volume, but your profit on every single pound is incredibly tiny because you're competing strictly on price against Stripe or Adyen.
Right, whereas the legacy branded checkout is retail. It's like selling a single, highly decorated artisan cupcake to a customer. Volume is lower, but the markup is huge.
That is a great way to put it. So as Braintree, the wholesale flour, drives that massive 10% volume growth, it mathematically dilutes the overall profit margin.
I see.
Combine that structural shift with the $2.4 billion in OPEX, and that 248 basis point drop makes logical sense.
Okay, so they have this captive audience of 439 million people. But the profit margins on moving their money are getting structurally squeezed. So what does this all mean? If they can't invent more margins out of wholesale, they have to find a totally new way to squeeze money out of this ecosystem.
Which brings us to the most fascinating pivot in this entire report.
Right. The sources highlight this really unusual event for a finance company. PayPal actually set up a massive activation at the Cannes Lion Festival.
Which is wild.
Yeah, for you listening, Cannes Lion is the premier global festival for the advertising industry. It's where ad agencies go to win awards. Why is a payments processor setting up a baby blue PayPal ads cart on the French Riviera to talk to ad execs?
Because they are officially stepping out of the pure financial utility space. They are entering the digital advertising arena.
So wait, what does this mean for you, the user? Is the PayPal app just going to turn into a targeted billboard? Like a grocery store auctioning off your exact receipt as you walk out the door?
Yeah. That is the ultimate logical conclusion here. PayPal is trying to build a closed-loop advertising network.
A closed-loop network.
Yeah. Think about the data they have compared to Google or Meta. Social media knows what you like or what you search for.
Right, which is valuable, but it's just guessing. I might watch a video about a Porsche, but I definitely can't afford one.
Exactly. Social media sits at the top of the funnel. PayPal sits at the very bottom, right at the point of sale.
Oh, wow.
They don't have to guess. They know exactly what you actually bought, how much you spent, and when you bought it.
That final purchase data is the holy grail for advertisers because it proves return on ad spend definitively.
Completely. And from PayPal's side, this is necessary genius. We just talked about how transaction margins are shrinking. Advertising is incredibly high margin.
Right, especially when you already own the data and don't have to buy it.
Exactly. It creates a high margin revenue stream that offsets the pressure on their core business.
But let's inject some reality here. Building a global ad network from scratch, reinventing Venmo, scaling Braintree, this requires massive amounts of capital. Do they actually have the war chest to survive this without bleeding out?
That's a very fair concern. But this is where PayPal separates itself from cash-burning startups. They generated $1.8 billion in adjusted free cash flow this quarter alone.
In one 90-day quarter, that's incredible.
Yeah, and structurally, they have $15.3 billion in cash and investments. Now, they do have $13.4 billion in debt, but their net cash position puts them on incredibly solid ground.
But they aren't just hoarding that cash for the rebuild. The report says they returned $1.5 billion to stockholders via stock repurchases just in Q2.
Yep, aiming for $6 billion for the full year.
Plus, they declared a 14-cent per share dividend. I got to challenge you on this. They're handing out dividends and buying back stock by the billions. Isn't this what a mature, boring utility company does?
It definitely looks like it on the surface.
Right, like a telecom company or a regional bank.
Yeah.
Are they quietly admitting their hypergrowth tech days are over?
This raises an important question about how public companies navigate transitions. The days of adding 50 million new accounts a year? Those are probably over.
Yeah, the market is saturated.
But they aren't just settling into being a boring utility. What they are doing is strategically using their massive cash generation to buy patience from Wall Street.
Buying patience. Okay, paying investors to wait out the awkward phase.
Precisely. Wall Street loves capital returns. By buying back shares and paying dividends, they keep institutional investors happy. It provides air cover.
While the analysts are happy with the raised guidance, Enrique Lores and his team are in the back room tearing up the floorboards.
Exactly. They are funding their own reinvention with the cash flow of their legacy business.
Okay, let's summarize where we are at with this Q2 report because there are a lot of moving pieces. The headline margins look a bit squeezed, dropping 248 basis points. And overall, active accounts have paused at 439 million. But looking deeper, they're processing a staggering 486.4 billion in total payment volume. Instead of chasing empty accounts, they are deepening roots with power users.
Pushing the transactions per account up to 60 times a year.
Exactly. And most importantly, they are taking the immense cash flow, paying Wall Street to be patient, and quietly building an advertising empire built on our actual purchase data.
It's a textbook transition from a pure user growth story into a deep value data monetization play.
Which leaves us with a final thought to mull over. And this is something I want you, the listener, to really think about next time you use a payments app. As PayPal shifts into advertising, where is the line between a financial utility you trust with your money and a targeted marketing machine?
That line is getting very, very blurry.
It really is. Will consumers happily accept targeted ads in exchange for free, seamless payment services? We'll have to see. Make sure to follow the show for our daily earnings coverage, where we break down the numbers that matter.
And how they impact your wallet.
Keep questioning the balance sheets behind the apps you use every day. We will see you on the next deep dive.